Hello, today we're going to talk about recession 2020. Basically, I believe that I'm not saying we are, but I believe there's a bigger chance for it in 2020, and I just want to make a quick video of it. Really, why I think that, and really what to do about it. I won't get into 100% why I think so. I don't think that's really not important. What's important is preparing for it and being ready for it as an investor. You always have to prepare for downturns and stuff like that. I'm not gonna get all political or whatever on you. I think so. So don't X out yet. But anyway, I'm just gonna get right into it. Basically, the I go through the reasons and then talk about how to prevent it at the end. Basically, we have inverted yield curves, and really that's been an indicator of recession for the last over 60 years. You can look, I can leave a link actually down in the description where you can actually look up the yield curves, and you can actually look up 2007, it inverted in 1990, it inverted, and every single time it inverted, I think it goes all the way back to 1989, 1980, where it inverted once again in a recession in 1991. So essentially, I think you can keep going all the way back. So essentially, every single time that inverts, especially when what I call a full invert, is basically the 1 month is actually higher than the 30-year. We're really not there yet. So I mean that's a good indicator. But usually the free month is went above the 10-year. So essentially the 10-year bond rate is lower. So essentially the free month is sitting around 2.37, and the 10-year is sitting at 2.26. So essentially, it's inverted. Basically, you should have what you should have is lower rates on the shorter ones and longer rates on higher rates on the longer rates. So essentially, you should have on the 1 month you should maybe have a 1, and then on the 30-year you should have basically a 3 or a 4. You should have higher. There's really not a big difference. Basically that's really a kind of a bad sign. It's been really correct. I won't go fully into it. Maybe I could maybe make a whole video explaining that. But basically, that's really what it is. So it's a good indicator to always look at, because it's really really accurate. Especially when it fully inverts and it fully kind of, interest rates go up too fast, and it's really not doing like in 2007. It really fully inverted where it was like almost, I think it was sitting at, I can leave links down the description. And another reason, the trade war, which ceased last free, is really what happens is with the trade war is basically what's going to happen is all the taxes on all the imports, and China's going to increase all that, and they're going to keep going back. If they keep going back, what's going to happen is they're just going to increase the prices of everything, which is inflation. So essentially, if you have inflation, the Federal Reserve, and if the economy, and that going to slow down the economy, and what will happen is the Fed will have to raise interest rates. It won't cut them. I think all these people are saying they're going to cut them. They're not going to cut them. Huh? They're probably going to increase if you have high inflation. If you have high inflation, that's what they do every single time. I mean, every single time when you have high inflation, the Fed will increase interest rates and slow down their economy. They rather put us in a recession than have very very high inflation. It's actually high inflation is actually even worse in a recession. So, and you have low unemployment. If you have very low unemployment, basically supply and demand, and that's why everybody's getting a raise and it's doing well, but that really just increases inflation. So essentially you have all them things, the trade war and all that. So the Fed's in an awkward situation where it's having slower growth, and then you're going to increase interest rates on top of it. It could, I'm not saying it will. There's no 100% in really business and economics. And really in life, there's no really 100%. But if it keeps going the way it's going, I believe that's really where it's gonna, it's gonna put us in a recession where you basically have inflation increasing, which we don't have that yet. Um, that's why I'm saying maybe in a year from now, maybe we're going to be maybe the start of it. So mid 2020. Because if you have low unemployment, everybody said, well, 1969, lowest since then. But actually, in the beginning of 1969, it did low unemployment. But by the end of 1969, we were in actually a recession. Late 69 and early 70, we were in a recession. So I mean, that's not a very good sign when people are, and it's good. And the average person is going on about because they don't really study economics and financials, and they probably don't have any money in the stock market. And if they do, it's in a 401k, and they probably don't even check it maybe once a year when they get something in the mail. So essentially, when the consumer is really, really confident, and usually because when I started in 2012 and getting into it, everybody was really, really scared. Everybody was really shooken up over the financial crisis, and everybody was looking pretty bad. So essentially, that's when the time you really want to start putting money in it. When everybody was gloom, it was this debt crisis they were going on while Obama was in office. You always hear on the gold, buy this and secure your money from this financial collapse. Buy gold. When people are saying buying gold on the TV, that's usually you want to buy stocks, because that means they get everybody on there on the thing and saying the dollar's going to crash and buy gold, and everybody's end of the world situation. And well, it never really happens, and that's actually been a horrible advice if you ever did that. And that's why gold usually spikes up for a little bit, because everybody's rushing in thinking they're going to get rich, and it usually sells off, and it doesn't do very much. So essentially, I'm not saying don't own gold or anything like that, but usually that's what people were saying back in 2012. Nobody was saying the economy was good. I mean, people had money in the stock market. They were saying, yeah, we were slowly recovering, but people that had basically the average person that don't have any money in the stock market, they were saying don't buy the stock market. It's horrible. I mean, the whole economy was horrible. We're double dip recession. That's what people were saying, and it was definitely a different time. Definitely a different time than what it is now. Everybody's saying, "Oh, the economy's going to go on forever." So when you get that, that's usually the peak, and usually that's when it goes way back down. So but anyway, that's the reasonings. But here's the more important things is actually how to prepare for it. So essentially, so you can't really prevent a recession, but you can prepare for it as an investor and stuff like that. So essentially, really the best thing to do is just I'm not saying sell your stock right now because it's going to collapse, because you never know. It could keep going up. So essentially, if you get a nice 20% gain off something, even when it pulls back a little bit, it still won't. You might break even eventually, and that's even if it does, and maybe that stock won't get hit as hard. So essentially, there's no way I can predict what stock's going to get hit hard and what's not going to get hit hard, or anything like that. And you never know. We might get lucky and miss the recession by 2020, and maybe 2021 we could get in one. You could miss 2 years out in gains. So essentially, I don't believe in sitting on the sidelines and watching everybody make money. But what I believe is you have to be very, very careful when we're in this. You can't just be throwing money in there mindlessly like you could do back in 2012 and 2013. Well, maybe not mindlessly, but you could kind of really almost throw really money at a dartboard and pick your 5 best growing stocks and pick and line them up on a dartboard and throw it at it, and you probably would have made money if you hold it for a while, because the economy was so slow and it had so much growth potential. So if you bought just Apple or anything, Amazon, or if you bought the biggest companies like the banks and stuff like that, you probably did very, very well, and hold them for this time. So essentially, you probably can't you can't really do that now, where you're basically just picking it and everything like that. So you have to be very careful and not throw a whole lot of money. And the other thing is, to be a good investor, you have to understand it's not all about picking stocks and when to get in, when to get out. It's also about managing money, where you're not in managing debt. So essentially, when the recession hits, I don't know about probably the average person, has a job or some source of income, to invest, you have to have some kind of source. That source of income might get pushed back. You might get your, if you work a job, you might get your hours cut back. Sales probably will drop. You might even get laid off. So essentially, that's what you have to understand. And if you're maybe a business owner online, people won't spend as much and everything. So essentially, that's really what you have to look into, essentially. And that's why what you should be doing is maybe cutting back on how much money you put in the stock market and start paying off debts. So essentially, like, let's say you have a bigger car payment. It's better just to pay off that than put money in the stock market, because basically it's the best way is to instantly, because it instantly increases your net worth. Because essentially, if you pay off all your cars and pay them off, so let's say the you don't really lose your job. Let's say you make $1,000 a month. Just making numbers up. I hope you make more than that. But let's say you make $1,000 a month today, and you put X amount of dollars aside and pay back all your debts. So essentially, if you pay all your debts off when the economy slows down, you have all that excess cash to really pour in the markets and really, really just slingshot yourself into really, you know what I mean? So essentially, let's say Apple gets hit in half, and it's just stupid for Apple to lose all that. But let's say it does. Let's say Amazon gets obliterated and goes down 90%, which I don't know. I'm just making up an example. Amazon could probably keep going and probably be worth a lot more. And let's say it goes all the way down and goes all the way back up. So essentially, you're missing out on a massive gain there. And if you pay off your debts now, maybe you will have a lot more disposable income to put into stocks and stuff like that. If you pay them off now, like your credit cards and stuff like that, just start paying it off. And the other thing is, if you let's say you lose your job, and you still have them credit cards, or let's say you still have them car payments, you have two options. You don't pay it and it gets repoed. You default on your loans, or you have to sell your stock at a loss to pay it back. So essentially, it's better just to start going, you know what, I'm just going to start saving money, not throw money in the stock market now. And really, so then you're prepared either way. So essentially, let's say the recession doesn't happen, you're prepared and you're a lot better off. But if, let's say it does hit, you're in a lot better shape than everybody else and can really take advantage of them lower prices. And that's really what you have to look at. So it's about really managing money and understanding that. So essentially, that's what I do. I don't put as much in there. I put more paying back my debts and stuff like that, because everybody has debts. It's just how it is. Maybe you don't want to pay back your debts or whatever, or maybe you can just save money and put that extra $1,000 or whatever your percentage, and you can work it out on your own. Maybe put in a savings account, so when you maybe lose your job or get your hours cut back or whatever during a slower time economically, you can have money to maybe because you to buy them companies at a lot less prices. And so the absolutely worst thing is when people lose their job and they're completely in lots of debt, and then they have to sell everything in the markets, and that's actually what drags the market down even more, is basically that action where people are selling, you're selling it, and people have so much debt and they can't pay off their car. So like, you know what, I have money in my 401k, and I have money here, there, in the stock market. I got 20 shares of Apple. I could sell that to pay off my car, because I don't want to lose my car. I don't want to lose my house. I don't want to lose this, and it's just the way it is. And that's why the market goes down even more during a recession. That's why it gets hit 50% for no reason. And you could be selling, and let's just say, I doubt when you're selling them stock thinking, oh, well, I'm paying at the book value. I'm paying even below book value, but I have to have the money. So essentially, people don't really care what the stock price is, and then they're just selling to pay for everything else. So essentially, and you don't want to be like that. So anyway, I hope this video was helpful. I could leave a link for the inverted yield curves and all that. Maybe I can make a whole video on that, because that gets kind of complicated. That's really bonds and stuff like that. There's a lot of things in bonds that actually help you evaluate stocks too. So maybe I can make a video on that in the future about inverted yield curves and bonds and stuff like that. Hopefully if this video was helpful, and hopefully it made you open your mind to it, and maybe you could start paying, saving a little bit, and maybe not putting all your money in stocks. And hopefully, unless you already have whatever your goal is or your amount that you think you need, the baseline is 6 months. So 6 months your expenses. Maybe you don't have any debts and you don't really care. Then it doesn't really matter. Then you can just keep putting money in the stock market and just move on your way. But I always believe, it's like Warren Buffett once said, in the stock market, it's better when it rains gold, you want to stick out the bucket, not the thimble. So essentially, and that's really what he's talking about. When it pulls back, you want to have quite a bit of cash for these pullbacks. So essentially, but anyway, that's all for today, and I hopefully it helped you out, and thank you for watching. Bye.